Assalamu alaikum viewers. Um, I will be talking about the reasons why I am buying UPS stock. So disclosures before we, dig deep. Some disclosures about me. I'm an IT engineer by education and profession, a CPA by interest. And I am a investor. I'm not a trader or speculator. I don't buy something with the intention of selling in few hours or few days or few weeks. Generally, I try to hold it long term, more than a year in many cases. This video is for information purposes only, and this is not an investment advice. I do not have business relationship with UPS other than being its shareholder and a customer from time to time. To the best of my knowledge, the information is current as of this writing. If you see inaccuracies, please correct as needed in the comment section. I have been wrong with my stock picks before. I won't be surprised if I am wrong again. So I try to kind of divide a complex problem into, a simple manageable chunk. So in order to understand a business, I think, it kind of helps to divide it into sections like what, how and how much. So what section defines, what is the, how do they make money? What does the business do? How do they generate the cash flows? So is it a product they're selling? Is it a service they're selling? That kind of stuff. So in this section, we will talk about what does UPS do and how they generate the capital, how they generate the cash flows. So UPS stands for United Parcel Service. They are a private courier service in US, but they do operate in more than 200 countries. They provide air, ground, domestic and international shipping. They have more than 500 aircrafts. They have more than 115,000 trucks, that operate on the road. So if you live in US, it's very hard when you go out not to see a UPS truck in any given day, right? It's very commonplace to see a brown UPS truck when you go out. Now, the second chunk, what I look for, is like how the business is being run. What is the track record of the management team? Is the management team competent enough, to run the company? Do we feel comfortable giving our capital to them so that, they can make decisions on our behalf as a shareholder or investor? So, CEO Carol Tomey and the management team overall, right? Not just the CEO, CFO, and the chairman, but overall, I'm speaking like based on my observation and the studies that I've done. Seems experience. They know what they're doing. CEO herself was a CFO for Home Depot for about 20 years. She understands capital allocation, and she started at a very junior level in Home Depot, and then she grew up the ranks and then reached CFO and stayed there for 20 years. That kind of track record speaks for itself about her understanding of capital allocation. Uh, Being a good CFO is not needed for a CEO, but I think it kind of helps. If you happen to be a CFO in your past career and you are a CEO now, it definitely helps, understand the capital allocation better. Chairman William R. Johnson is a former CEO of H.J. Heinz Company, the ketchup company. So he has experience running a public company and being like in charge of the company or the main decision maker of the company. So he does provide, I think that kind of experience does add value as a kind of advisory role to the management as being part of the chairman. Long-term debt for UPS is around 24 billion. So if I take the market cap from yesterday, around 75 billion, that's approximately 32% of market cap. I generally like to see the long-term debt less than 35% of the market cap. So I think this is well within the range. Um, Also to note that UPS market cap has fallen, approximately 20, 25 or 30% in the last few months because of the earnings, and we will cover that, why it has fallen so much. So if I take like, few months old market cap around 100 billion, 24% is very manageable debt in my opinion. So there is nothing to worry about in the how part. How is the company being run? I think they are doing an okay job. Long-term debt is manageable. So I don't really see any cause of concerns in the how part. Now, once we understand the what part and the how of the business, then we have to ask a question, how much the business is selling for. If we were to buy, I think as part of like value investing, that we need to kind of ask ourselves is that if are we comfortable buying the whole business, right? Not just a piece of the business. So if market is telling that the whole business is on sale for 74 billion, is that a correct price or is that a good price, that we can jump in and purchase a company with a view that it's going to generate cash flows for us in the future for many years to come. So, shareholder, now I think the first bullet point talks about the market cap, which is 74 billion, approximately around $87 per share. Shareholder equity as of the Q2 statement, the end of June, is around 16 billion. So, capital for future earnings, the way to calculate that is that market price, as of like today, the current market price 74 billion minus 16 billion, we are getting in equity on the books, which is 58 billion. 58 billion is what we are paying the company for future earnings, right? So we are buying the company with the hopes that it is going to generate more than 58 billion for us in the future. So what I like to calculate is the payback period, at what rate we are going to get our 58 billion back. So if I just take the free cash flow for 2024 around 6 billion, right? And I assume that, because I like to look at the downside first before looking at the upside. So what I'm assuming is that, okay, there is no growth, and there is no deceleration as well. Company will continue to generate 6 billion free cash flow for next 10 years to come. So if I divide 58 billion and divided by like the 6 billion that I'm expecting every year, I come up with a like approximately 10. So that 10 is nothing but the 10 years is like the payback period for me to receive my capital that I'm paying today, 58 billion that I'm paying today. It will take me 10 years to get back my capital. So at what rate I'm receiving my capital? 10%. So also just like consider that you are getting your capital back in 10 years, but after that it's going to be free run. You got your money back, and then from that point on, anything like for next 20 years, 30 year, 40 year, however long the runway for this company is, it's very hard to predict. Now you have to evaluate from time to time. You have to, once you invest in something, you have to uh, keep yourself updated with the quarterly earnings, with the yearly like updates, key events update, and things like that. So assuming that this company has a long runway greater than 10 years, after 10 years basically you are getting a free ride. You got your money back, and everything else the business is generating for you is just like a positive return, free money for you. So that is the way to think about valuation. Now, let's move on to the next section, which is moat. Moat is a competitive advantage, that business create for itself to keep the competition away, from getting into their revenue, right, or getting into their cash flow. So there are there are a few reasons where I feel that UPS has a strong moat, or a good competitive advantage, and it is durable as well. And that is something I look for when I'm investing for long term, is that the business needs to have some kind of a moat around it so that the cash flows are protected for the future. So the reason why I like the moat are the following. It's a duopoly business. The private, packaging or courier business in US is a duopoly. UPS and FedEx are the two important players that does the packaging. UPS is one of the main players. So, that's like an advantage. You don't have a lot of competition here. The second is that convenience, right? There are so many stores, like, very conveniently located every maybe like, 5 to 7 minutes or 5 to 10 minutes at the most in different directions, whether you talk south, north, east, west, wherever I have lived, in different places, in different states. I have lived in the United States. I have always found, very convenient location for a UPS store near me, right? So that's kind of another advantage, that it kind of speaks about its moat. They have a dense network in the US, so they have a lot of locations, shipping locations, sorting locations. Their network is very dense. So if you want to mail a package within US, UPS is preferable over FedEx. FedEx is good for expedited as well as global packages, right? Whereas UPS is good for like a non-expedited, regular processing time, regular mailing time, and then within the US. they have a very dense network, better network than FedEx, in my opinion. That is the reason why, I think that's another like added advantage to them over the competition. The next one is that UPS has been around for more than 100 years. It takes a lot of time and maturity, over the number of years to kind of mature your network, right? Because packaging is like all about optimizing, from the shipping point to the destination, how quickly and how cheaply you can get it there. That's what it comes down to. So when you have built something and you have matured that over 100 years, it's very hard to replicate. A startup cannot come and just say that, okay, I'll just do the same and I'll build something in 1 or 2 years. The relationships, setting up the people, your assets, positioning your assets based on your location, the demand and all that knowledge, the data, it's very hard to replicate. So that's another source of moat for UPS. Now, the key question, why is it trading low, right? I mean, I think if the business is so good and everything seems positive, why it has come down? I think, maybe if you take 2 year, it was around $170 or something, and then it came down to $130. From 130, it fell to $110, and from 110 now it's at $85. So if you think about it, the journey in the last, since I would say 2023, has been the downward trajectory, right? If the business is so good, then why is the stock price falling, right? It doesn't add up. So for that, I think, let's kind of understand better. What I like to believe, the first point here is that market is not stupid, right? Market is very efficient. Market is forward looking. Before you can see the reality on the ground, the investors kind of see that coming, and then they position their portfolio accordingly. If they see something that is going down the hill, then they kind of start selling and they take their cash out. So market is not stupid. That is something we definitely need to keep in mind. So market is very efficient, market is smart. So there is a reason why market is selling. Now we have to understand that and then decide whether it is a short-term thinking or is it a long-term damage that has been done. We'll come to that. So for now, just like understand that market is selling for a reason. The stock price has come down for a reason. Okay, what are those reasons? Revenue and EPS, earnings per share deceleration. So if you see on my screen here that the 2022 to 2023, there is a drop in revenue of 10%. From 2023 to 2024, there is an increase of like maybe 1% in revenue. So the point is that, this is the reason why. If you see here, instead of increasing from 2022 to 24, that the revenue has decreased. And same thing with the operating profit. It was around 13 billion at one time. And now from 13 billion, it was around 9 billion in 2023. Now it's 8.5 billion in 2024. Who knows? It might be 8 billion in 2025. That's what market is thinking. And that is the reason why they're selling the stock, right? That's one. Second is that Amazon volume glide down. Amazon made up like around 12% of revenue, in 2024. So if I take like 91 billion, so 91 billion approximately around 11 billion or 12 billion is belonging to Amazon. Now that 50% would go away by 2026. So if we are looking into 2025, assume that there is a 50% reduction. We are talking about out of like 11 billion, 5 billion or 6 billion is gone, right? So that's like another reason that like market is expecting revenue will come down significantly. The last reason is stagflation and recession fears. So stagflation is a time where the economic growth is very slow and inflation is very high. So with tariffs, right, there is a good amount of chance that the inflation will keep going up, if the tariffs are not controlled, because we keep hearing every day there is some kind of news about like, this percentage, that percentage on this country, that country. If that nonsense keeps going, then definitely it will result in inflation. And since the interest rates are high, economic growth is already slowing down. So we are stuck in a period where our GDP is not growing as much, but we have a high inflation, right? So that's like a very bad scenario to be in. And when that happens, it's kind of like a recession. It's like a recession multiplied by two or three, something like that. So in that scenario, economic activity slows down. So the movement of goods slow down. So if that happens, then obviously not just UPS, the entire transportation sector would take a hit. And that is also another reason why investors feel that this is not a time to invest in the transportation sector. Now, this is like what market is thinking, and it's good to be aware of it. It's good to study and good to understand. But my view after realizing and reading all this is that temporary. Let's take, one by one why I feel this way. Market is not stupid. Yeah, I get that. I think, sometimes, but market is not stupid, but market can be short-term oriented, right? Market is thinking only like couple of quarters or couple of years, but I'm thinking long-term, right? If you were to buy a house or a business, right? So you have to think in many years ahead. How would you be comfortable holding this business as a permanent owner of the business? So that's what that so there could be like a difference in understanding about the time horizon of a particular investment between the market and an individual investor. Now, revenue and EPS deceleration, yes, it is quite likely that it will decrease. But my point of view is that the space that will be created by Amazon with e-commerce tailwinds, it will be taken by somebody, right? May not be, as like to that extent, but it will be close. But eventually, in like maybe few years, or maybe even just like less than like maybe a year or so, right? That volume, that space, that vacuum would be taken by other customers, and it will make it agile and nimble, and they can do different things, and maybe like focusing on high growth areas that they've been talking about, healthcare, logistics, right? Things like that. So they might go into that, and I don't really expect that it will decelerate more than what it has. Maybe a little bit here and there, but not significantly. And in my evaluation, which I will cover in the next few slides, is that I've considered a worst case scenario, right? And I am not expecting anything worse than my worst case scenario. So, stagflation, recession fears, yes. I mean, I also don't know how the economy is going to play, how the market is going to behave, what will happen to the economy, whether we will have a recession or not. But if I take a long-term view, even if it's a recession is going to go down, it will be like down for some time. But when things improve, it will come back up, right? And until then, this stock and this company is known to pay healthy dividends. So I think you get paid for waiting, and you may not get the same opportunity again. What if a recession doesn't happen? Maybe the stock would rally from here, on improving economic indicators. So you never know. When you see something that looks like a deal, I mean, my point of view is just to act on it, right? There is like, if you keep on waiting that there might be a better entry point in the future, then you may get it, you may not get it. So you're taking a chance, and I don't want to take a chance for a good business that I understand seems reasonable and has a strong advantage in the long term. So now let's go to the next slide. Okay, if you remember, I've already done the valuation previously, but now I'm doing it with a more conservative, in a worst case scenario basis, right? So again, let's start with how we did last time, which is market cap of around $74 billion, $87 per share. Shareholder equity as of Q2 is around 16 billion. So that part is the same as like the previous slide, 74 minus 16, 58 billion. So today, if we were to buy the company, we are paying $74 billion. We are getting 16 billion on the books in terms of assets, in terms of equity, tangibles, and things like that. So 58 billion is what we are paying for the future. Now, last year, company had generated 6 billion in free cash flow. I am taking the Amazon's worst case scenario because it made up like around 10 to 12% of revenue. I am cutting the free cash flow by the same 10%. That's the worst case scenario, meaning like I'm expecting that business has gone away. They were not able to fill the vacuum. They will just do the normal business. The non-Amazon business will continue for the years to come. If you take that scenario, that cash flow is around 5.5 billion. Now, if I divide 58 billion that we are paying for the future earnings, and by 5.5, I'm getting a multiple of 11. That means it will take 11 years for me to receive my capital. So if I do the simple math, right, I'm not doing the cumulative aggregated, growth rate and cumulative compound interest and all that. 9% per year is at the rate of return I'm getting. So in an average case scenario, I'm getting a 10% per year. In a worst case scenario, I'm getting a 9% return per year. So I didn't even consider the best case scenario, right? So, I mean, my thinking is that if you take care of the downside, upside will take care of itself, right? That is the thinking behind. So, my focus is to kind of, look at what is the worst that can happen. And if that happens, what is my return going to be, right? I think that's what I'm trying to get at. So when I look at it, and when I look at the treasury rate, the guaranteed interest rate today is like 4%, 5%, between like 4 and 6%. 9% is still much better than that. For a company with a strong moat, with a strong network, with a strong presence, like you don't kind of get this type of deal every day, right? Or every year, every like, maybe I don't know, 5, 10 years you get some kind of a deal like like this company like Johnson& Johnson, Procter and Gamble, UPS. These are companies with like a very wide moat. They have something that others don't. So when you get something from these companies that is like within 15 times earnings or within their 10 times free cash flow or 11 times free cash flow, I think it is still a good deal in long run. And as I said, you have to take a multi-year view. If you just take next 2 quarters, then maybe this is not a good price for you. It may go up, it may go down. I don't know how it's going to behave. But in the long run, this business will do well. There will be a need for like courier providers that can mail packages. That is not going to go away. Of course, AI can make some improvements, but AI will not be able to physically deliver the goods and replace UPS, right? So with AI, that's not happening. It might optimize which UPS would use to optimize, and maybe they are already doing it to optimize their route and the network to kind of reduce the cost. Yes, those improvements can be made, but there will still be a physical need for people, for somebody to pick up the package from the shipping point and then take it to the destination point. So I think I am not seeing that to be going away for any time soon. So in that sense, it is kind of pretty secure business for many years to come. Now, let's see the positives of this business, right? Uh, the management has emphasized that they are focusing on quality versus quantity. So, Amazon business is a good example. It's not the Amazon that was trying to move away the business, it's the opposite. UPS does not want Amazon business. The contract was up for renewal this year. They said that, okay, Amazon is like having a very high volume with their scale and network effects. They are trying to squeeze UPS. With their margins, basically they're not really making good amount of money. UPS is not making much money on Amazon. It feels like they are doing, a lot of work for very little money. So their thinking is that if we free up that space, we might be able to fill that space with a better margin business like healthcare logistics. There the quality of the service matter, the timing of the service matter, and the customer is willing to pay up more, right? Because the margin would be higher. Because if you have your lab results and if you need to get some medication in a very like a cold storage facility and a cold storage way along the route also, then you don't really care about the price, because for you getting it safely from point A to point B is more important than anything else. So you're not going to nickel and dime and negotiate about the price. So I think UPS management wants to focus on those type of businesses where they have a higher margin and they can make more money for doing the same type of work that they are doing for Amazon currently. So their focus is on quality versus quantity. So they have repeatedly said that better, not bigger. So I think that's a positive. I like that. Anything they can do to improve margin, market will like it, and the stock price will react positively to those developments. The second point is that, growing in healthcare logistics. This is something I've already alluded to in my previous point that, they are trying to grow in healthcare logistics. They are also like on the way to reduce cost. They started a couple of years ago and they are reducing like cost aggressively. And they need to do that. Otherwise, it will balloon up and there won't be like enough free cash flow for shareholders, and market will not like, and the stock price will go down further. So I think they are having the right initiatives to reduce cost. They should continue that journey and try to look for ways, to reduce as much cost as possible. They are committed to dividends. That's another positive. Right now, I think they are generating, if I say last year, they generated around 6 billion in free cash flow. They paid 5.4 billion in dividends. So it is kind of cutting very close. They have committed to dividends on in the recent like earnings call, the Q2. But again, I think, it's very close. I won't be surprised if under challenging circumstances they kind of cut the dividend, uh, and then maybe increase it afterwards when things improve, right? Hopefully not. I mean, I think they will do whatever they can. They will pull maybe other levers to kind of manage, but I think cutting the dividend would be the last resort. So until then, right, I think we do have their like kind of a commitment, to kind of continue to pay dividends, which is a very good amount of dividend for a stock that is around $85. We are getting around $64 per quarter. That's like around $6.50, right? Which is not bad at all. That's like I think 7 or 8% dividend yield while we wait for the stock price to recover. Now let's look at some of the negative and the risk factors that we need to be aware of, that we need to kind of keep in mind whether it's a right investment decision for other or not. Because if you see these risk factors and this is something you cannot tolerate, right, then you should not be even considering this as an investment. You should be staying away from this company. So, like I said previously, free cash flow is tied to support high dividends. They are cutting very close. If they can manage somehow and they can like pull rabbit out of a hat like multiple times, they might be able to continue to pay dividends. But with the current revenue, it's getting harder and harder as they go. Unless they are able to grow revenue, then I think it is pretty sustainable and they can continue to pay dividend and maybe even increase dividends. Uh, the second negative factor is that may not be able to fill the vacuum left by Amazon. So right now they are talking about healthcare logistics, they're talking about other high margin areas. So it's like a new area for them. I hope they are able to fill the gap, but there is no guarantee that they would be able to find that find the customers that can fill, or those customers that can fill that big of a space that will be left by Amazon. So that's something to keep in mind. And then it is a union shop at the end of the day, so there is a like a risk of high cost, employee cost in negotiations in bargaining. So right now I think the contract is valid until 2028 and it will be up for renegotiation at around 2028. And if the costs are that are negotiated are going to be much higher than what they are today, then it will be another like negative, for the free cash flow. The other thing to note here is that pension, if you see here in the screenshot that I was able to capture from their 10K, I think if you see here December 31, 2024, they are underfunded. If you see US pension benefits is underfunded by 5 billion and US post-retirement medical benefit is underfunded by approximately 2 billion, right? So that's like 7 billion there itself. So they if this cost increase and they are not able to generate enough or grow their cash flows, then it will they have to cut dividend. There is no choice. They have to cut dividend and they have to fund these plans. So it's like additional costs that are there, down the road, but it can come and bite any time in the future. So as a investor that is looking to the future, you definitely need to keep this in mind. Now, one other thing that I kind of look for is that, to see if who else is thinking like me, right? Maybe am I alone or do I have company? What are the other successful investors thinking or institutional investors thinking about it? One thing that made me like feel good about my analysis is when I looked at the Amana mutual funds, right? I see that they bought this stock a couple of years ago. I think it's a long-term holding for them. They bought it around uh, $174. I think maybe it was 2022 when it was high or 2023, something around somewhere along those lines. They bought it for $174. And right now the price is $87, literally 50% discount than what they bought. And Amana has a good track record, of like creating shareholder value. It's at least they keep up with the market. They have not really destroyed the capital. So that makes me feel that there is some and they have a team. I mean, like maybe the way I work is alone and I am doing my own analysis. I don't have any team member that I can bounce my ideas off. But when you look at it, then you think that okay, there are there is a team of smart investors, that do this for living, and they also are feeling like me, or they also think that there is value in here, whatever the price and sentiment that seems to be temporary, but in a long run, this business will do well. It will continue to pay dividend. It will manage itself well, right? So that's an affirmation. That's always good to kind of look to kind of validate your thinking. So that's just one data point for you to keep in mind. Other data point that kind of makes me feel good about my decision to invest in UPS is insider buys. So Peter Lynch, who was one of the successful, or who is still the one of the successful investors, of our times, of modern times, is he has said that I don't really care what you say on earnings call and whatnot, when he was referring to the management team. I pay attention to what you do with your money, right? So if you put your money where your mouth is, meaning you are buying when you feel the stock is down, that speaks volume, right? Without you being saying, how good the business is and trying to sell the business to the investors, you kind of show it by action, by investing in your own business with your own money when you see that it is down. So recently, I think on August 1st, after the earnings release, when the stock went down and took a beating around 86, $85, if you can see here, William R. Johnson, who is the chairman, he bought some 432,000 worth of stock. Carol Tomey bought around $1 million worth of stock. So that goes to show the confidence. I would have wanted to see more like officers, maybe the investment officer, maybe the CFO, maybe the chief procurement officer, maybe the IT chief information officers and all that to buy. But we don't live in a perfect world. I think the confidence from the chairman as well as the CEO is good enough for us to kind of a positive affirmation that, yeah, I think our thinking seems to be in the right direction, and we are not the only one thinking this way. Okay, with all that is being said and done, right, I always like to say that, a few word of caution in the end, that whatever I have shared is my thinking today. And it keeps evolving based on our world is changing every day, every minute, every second. If I come across any news which could poke a hole in my investment thesis, or which could, make certain of my assumptions incorrect or invalid, I change my thinking and I try to exit. So that is something that you have to keep in mind. This is not set in stone, even though our goal is to be the long-term investor. But if there is a material update, to the macro, overall economy, or to the micro, to the company, or to the industry, then I would not hesitate, to maybe exit the position. Sometimes, I have exited even by taking a loss. So you never know what's future is going to hold. So this is my thinking as of today. In the future, if something changes, then I might change my mind and I might sell my position. So with that said, I think that's it for me for today for the UPS stock. I plan to create more videos for you, informational videos, educational videos in the future. Please, provide comments, as this is just the beginning, and this is my first video. If you feel that there are certain ways, or by doing certain things differently, I can improve, feel free to let me know, and I will try to take that feedback and incorporate that feedback in my future videos. Thank you very much for watching. Thank you very much for your time. Happy investing. Take care. Bye.